Hello and welcome back to this video number 2. In this video we will look at the foundation of financial markets through the 5 big asset classes. In fact, we will look at the different asset classes through their historical returns and risk profiles, when to invest and or not to invest in those assets, and what weighting to allocate. First, what is an asset class? An asset class is a group of financial instruments which have similar financial characteristics and behave similarly in the marketplace. It is comprised of securities that have similar characteristics, attributes, and risk-return relationships. Here, the different asset classes are first, the listed, where you do have like stocks and equities, fixed income bonds, foreign exchange, cash, which is monetary market instruments, commodities, and gold. And for the non-listed assets, we have real estate and infrastructure. For non-listed assets, to get exposure, you will find trading vehicles like REITs, funds, or stocks. So let's look now at asset classes risk returns. What about the asset classes risk returns and their liquidity? The stocks and equities historically have higher returns but greater risks. They provide a very high liquidity. Fixed income and bonds have lower returns but lower risks than stocks. You do have like different bond classes and you need a minimum capital higher than stocks. And this is less liquid than equities. Foreign exchange is trading on big volume, but still this is a small universe and it provides a high liquidity. For commodities, it's mainly driven by macro, supply-demand, politics, and economic cycles. For real estate, this is mainly long-term investment, and as we've seen during the great financial crisis in 2009, it carries big risk, showed with possible over-leverage or liquidity issues. Finally, infrastructure are long-term investment, and they require big capital with very poor liquidity. Understanding asset classes will allow diversification. In fact, as each asset class has its own risk and return profile, it is fundamental to use diversification to obtain a balanced investment portfolio. First, by understanding the weighting of the different economic actors. As we will study in video 3 with GDP, economic participants carry different impact on the economy. First, through the governments, which is the G of the GDP, then with the investment from companies, which is the I, private consumption, which is the C, or householdings, and net exports, which is the X. So here, each market participant, governments, households, companies, trades, have different impact and different weightings. For example, Germany is heavily dependent on exports like South Korea. On the contrary, the US relies heavily on private consumption, which represents roughly 70% of its GDP. Secondly, we need to look at the possible regulation, meaning which asset could be impacted by a change in regulation, for instance. For example, how do you tax dividends, gains on capital? That will be for an investor, if the government is helping certain industry or not. The third point is where are we through the economic cycle and which asset class should we favor. Assets will react differently depending on which phase of the cycle the economy, as we've seen before. And as we will see in the next slides, depending where we are in the economic cycle, we will have to do arbitrage allocation between asset classes. The fourth point is through economic factors. Not only the economic cycle plays a role, but economic factors like inflation, industrial production, money supply will affect asset classes. And finally, through the active role of central bankers. Here, understanding the role of central bankers is always key, as they have a big say in the cost of money, the amount of liquidity, and the money supply. Like with our mandate, we need to understand the different central banks' mandate. Let's look now at the economic cycle. The economic cycle goes roughly into 4 phases. In the first phase, which is called the recovery, the economy is below trend growth but accelerating. In the second phase, expansion, the economy is above trend growth and accelerating. In the third phase, the slowdown, the economy is above trend growth but decelerating. Finally, during the contraction phase, the economy is below trend growth and decelerating. So what is the impact, or what are the impacts of those phases versus the asset class? In the first phase, which is the recovery, as we've seen before, the economy is below trend growth and accelerating. Here, equities will be the best performers, as they are benefiting from recovering economy. Credit market will be outperforming government bonds. Here, the best sectors or industry will be the cyclicals, the financials, the consumer discretionary, and industrials. On the contrary, consumer staples, healthcare, energy, telecom, and utilities will underperform. In that sense, 2009 is a very good example. In 2009, the S&P was up roughly 26%, and bonds were only up 3%. The top three sectors were first information technology, up roughly 50%, materials, still, same, 50%, and consumer discretionary, up 40%. And the bottom three, still up, but underperforming the market and the top sectors. You had utilities up 12%, consumer staples up 14%, and financials up roughly 18%. Let's look now at asset classes versus economic cycle during the expansion phase. Here, the economy is above trend growth and accelerating. Equities will still be the best performers. Government bonds will be the worst assets. The best sectors will be technology and industrials versus the worst one, utilities and materials. Here you can look at the performance of the S&P in 2013, when the S&P was up a big 32%, bonds were down by 2%, and the top three sectors were consumer discretionary, healthcare, industrials, and the bottom three were utilities, materials, and energy. So let's look now at the phase 3, which is the slowdown. Here, the economy is above trend growth still, but decelerating. Here, in that phase, in that cycle, you don't have real underperformer or outperformer between bonds and stocks. For the sectors, consumer staples, utilities, energy, healthcare, and materials will do better, will outperform, whereas consumer discretionary and technology will underperform. In that sense, 2007 is a very good example, with the S&P up a mere 5%, bonds up 6%, so bonds outperform stocks, but not by much, and the top three sectors were energy, materials, utilities, and the bottom three, as you can see here, two of them were down big time, were financials, consumer discretionary, and healthcare. Now, the last phase, which is the contraction phase, where the economy is below trend growth and decelerating. First thing first, government bonds will be the best assets. You will have to reduce exposure with increasing your cash, and stocks in that contraction phase will be down big time. Here, the best sectors relative to other assets will be consumer staples, healthcare, telecom, utilities, and the worst one, as we've seen in 2008, will be financials, materials, technology, and industrials. Here at the bottom of this slide, you can see that in 2008, the S&P was roughly down 37%, bonds were up 8%, and the top three sectors were consumer staples, healthcare, and utilities, but still massively down, and the bottom three were financials, materials, and IT. So if you look at the stock market in the contraction phase, everything goes down. So let's look now at the yearly asset class performance from 2007 to 2018 through different ETFs. As you can see, this is a good summary because we went through a cycle, a big economic cycle. In 2007, which is the phase 3, you can see here, this is the one, it's similar to the phase 3, where emerging markets were doing very well, and the bonds were outperforming stocks, but not by much. And here in 2007 we see that it started to underperform massively. Then in 2008 you do have like the recession, which is the phase number 4 here. Okay, here the best performing asset class are bonds, and at the bottom you get emerging market, and any stocks will be down massively. In 2009, which is that one, you do have like the phase 1 that we've seen before, which is the recovery phase. Here it's risk on big, where stocks, emerging market, everything that is very risky will go up massively and not perform anything that is risk off. So bonds will be at the bottom with cash, and emerging market and stocks will be at the top. Then the last phase that we haven't covered yet is the phase 2 that we had in 2013. And in 2013 you see that small cap, mid caps, large cap, all the stocks don't outperform the market, whereas bonds were small down on the year. So here let's look again at asset class performance from end of 2007 to end of 2018. As we've seen here, emerging market did pretty bad over the last 10 years, but are in reality okay on a longer time frame, meaning since 2000. So as you can see here, the compounded return for emerging market is flat to small negative, but the volatility is pretty high. It's the highest volatility. So the worst year was down 50% and the best year was 69%. The second thing that we can notice is commodities are down 8.5% on a compounded basis through that cycle. So commodities have been horrendous as the end of the big super cycle, with China slowing and moving to less exports. Here you can see that mid and small caps have been outperforming big caps, which is historically the case, as you are taking more risks by carrying and having small and mid companies in your book. Then finally, bonds have been returning on a compounding basis 3.2%, which is roughly what you should have, and cash has been doing the job with 0% return. So let's look now at what the US consumer hold in their portfolios. If you look at the first column, this is the equities, and roughly the US consumer has been holding 40% of their liquid financial assets into equities. In reality, they do own very little in bonds, as we can see on the right hand, corporate bonds, where they do have like 1%, and very little in money markets. So 40% is into bonds, and the others will be into liquid short-term assets. So let's give now a description of the stock market. The stock market at the end of 2018, the global market capitalization was above 80 trillion versus 85 trillion roughly for the world GDP. Out of this 80 trillion market cap, the US represented roughly 40%. Stocks can be traded over regulated exchanges or over the counter, which is OTC. There will be two types of markets. The first market is called the primary market. It allows companies to issue and sell shares through an initial public offering or an IPO. The secondary market, where securities issued in the primary market are bought and sold. So this is the second market after the IPO. This is the stock exchange. As we will see later, and this is very important for the trading, is stocks exchanges have trading hours. And like in Europe, possible auctions at the beginning of the day, midday, or at the end of the day. Examples will be the New York Stock Exchange, the NYSE, which is opening locally from 9:30 New York time to 4 p.m. London Stock Exchange is open in London from 8 a.m. to 4:30 p.m. So here are the top 10 largest stock exchanges. Here, no surprise, with the top two with the US, with the NICE and the Nasdaq. Then you get Japan, China, Eurozone. So that is very similar to the weighting of each of these countries into the GDP global. Okay, so if you look at the weighting of the US into the world GDP, if you look at China, if you look at Japan, in Eurozone, they are in the top 4. And this is the same for the equity market. So let's look now at the global equity market's capitalization. This is the same data, but in billions of dollars. Here you can see Australia, Canada, China, Eurozone, Hong Kong, Japan, Singapore, US, other developed markets, emerging, and the total. But the most important one is the second one here, which is the same but in percentage. What you can see is from 2004, the rise of China and emerging markets. So here, let's look through this. If you look at China, went from 1% to 10%, and emerging market went from 4% to 17%. So the two compounded went up by roughly 20%. And at the same time, the Eurozone lost 8%, Japan 9%, US 8%. So you see the move from developed market into emerging markets / China. Stocks go through a classification. So in our industry, in the financial market, most market participants will use the GICS standard. This is really the industry standard, and it goes for global industry classification standard. It was created by MSCI and S&P in 1999. Here you will have 11 supersectors, and you will find these 11 supersectors on the S&P. Then you go down and filter down into 27 industry groups, 69 industries, and 158 sub-industries. It is universal, so that is done for both developed and emerging markets. The review is done regularly, and by using this great product, you can identify very specialized sub-industry. That means this product benefits both passive and active management. Here you can see at the bottom the link if you want to know a bit more about this stocks classification. Again, very important, the GICS is really the standard used by the industry. So let's carry on with the stocks classification. The GICS 11 sectors are divided into defensive and cyclicals. So on the left hand, which are the defensive, you get the first sector, which is energy. And you will find the ticker for the ETF, which is XLE. Then consumer staples with XLP, healthcare, XLV, communication services, XTL, and utilities, XLU. And on the right hand side, you have cyclicals through materials, industrial, consumer discretionary, information technology, real estate, and financials. But in reality, you can apply the following. First, the cyclical sectors, which are energy, financial, industrial, materials. Then the growth sector, technology, consumer discretionary, communication services. And finally, the defensive sectors like healthcare, consumer staples, real estate, and utilities. And this is extremely important when you do the allocation. And the allocation versus the economic cycle. Depending on where you are in the economic cycle, you will favor probably more the cyclical sectors if you are at the start of the economic cycle. If you are at the end, you will go for defensive sectors. As a follow-up for stocks classification, and on top of GICS classification, we can classify industries by how they react to the business cycle. There are three types. First one, which is the growth. For growth stocks, sales and profits growth are above average and independent of the business cycle. They generally do not pay dividends and reinvest earnings to fuel growth. The second classification, which is defensive, in theory, defensive companies experience stable performance during business cycles. Their earnings and dividend growth should be constant over time, and correlation with the economy is low. Finally, the cyclical companies are affected by the economic environment and follow the economic cycle. During an economic slowdown or downturn, cyclical companies record lower sales and earnings. They are correlated to the economy. So let's look at an example through Yahoo Finance. Here, I took Microsoft as an example. So if you go into the Yahoo Finance website, they will give you in the profile tab the sector and the industry. Here for Microsoft, the sector is technology and the industry is software and infrastructure. So if you wanted to find any companies that's got exposure to software and infrastructure, you just have to do the filtering on this industry based on the GICS. What I've done here is just took the returns of all those ETF or 11 sectors from the S&P from 2007 to 2018. And what I wanted to highlight is the most important data from those 11 years. As you can see here, energy has an annualized return of 2%. So very, very poor. The second thing that I find extremely interesting is financials. So financials have been extremely volatile over the years, down 50% or more and max up 60%. So here financials with a bit higher return but with a much higher volatility. So in an adjusted risk return, financials have been doing pretty poorly, meaning again that the returns risk adjusted are not been very good. Same thing with the materials that have been showing or recording pretty poor annualized return versus the minimum or max return. The second qualification could be done by size. Obviously, you can take the stocks and use market capitalization as a filter. So market capitalization is the number of shares times the share price. The first one and the smallest companies are the micro caps, where the market cap is between 50 million and 300 million. Then, if you go bigger, you have small cap companies, where the market capitalization is between 300 million and 2 billion. The mid caps will be between 2 billion and 10 billion, the large cap between 10 billion and 200 billion, and the mega cap with more than 200 billion. In reality, market capitalization is a kind of a rookie filtering, and I think that it's much more important to look at enterprise value. With enterprise value, you do have like the market cap plus the debt minus the cash. And when we will be doing more fundamental analysis, the criteria will be enterprise value and not market capitalization. So let's look now, same things, but instead of going into the Yahoo Finance, let's go into the Reuters.com website. So same thing with Microsoft. As you can see at the bottom, the market cap is roughly 1 trillion. So all this information will be available for free on very different financial websites. So let's look now, after the stock market, let's look at fixed income. Fixed income is much larger than the stock market. At the end of 2017, you had roughly 100 trillion versus 85 trillion for the stock market. Fixed income is issued by a borrower from a lender. The bondholders hold a higher claim on the issuer's assets than the stockholders. So normally, bonds are safer than stocks. This is something extremely important to remember, especially as companies are holding more and more debt based on cheap financing. That means as stockholder, we really need to have a much higher return, better risk profile than bonds, as we are less safe than the bondholders. On the contrary, bondholders have no voting rights, unlike stockholders. Bonds hold multiple maturities. You can go from 1 month to 20 years, depending on the need of the companies. But as an investor, and for us, it's less liquid, and you either trade via an exchange or OTC, but most of the time you go OTC, and that will be a problem, and that is a problem for retail traders. The future cash flows of the bond will give us the bond price, versus for stocks, the future earnings will give us the stock price. So fixed income, let's go now to the bond characteristics. It has a par value of $1,000, but can be much greater for government bonds. The interests are roughly and most of the time paid every 6 months. In a bond, you do have like the name of the issuer, the coupon or the interest rate, the maturity date, the rating agencies, and its unique ID. To find bonds for US companies, I strongly advise you to look at this website on the FINRA, which is the US regulator for bonds. So you do have like different types of bonds. There are different types of issues, meaning that the assets collateralized are very different. Here you have the corporate bonds, the US Treasury securities, the TIPS and STRIPS, US saving bonds, mortgage-backed securities, MBS, agency securities, municipal bonds, international and emerging markets bonds. So going through all those different bonds, you can see that the counterparty risk is very different. If you own a US Treasury security, that means the counterparty is the US government. Whereas if you own an international or emerging market bonds, that could be either like a country or a company, so not the same risk. Fixed income in numbers. Again, as we've seen before, is much larger than the stock market. At the end of 2017, 100 trillion, as we've seen, versus 85 billion. US again, 40%, same as stocks. Europe, 30%, Japan, 13%, emerging markets and other developed markets at 20% altogether. So that gives you the following in terms of outstanding in billions, like we've done for the stocks, but this one is the most interesting table, with, as you can see, the 4 big players. Same here with US at 40%, 30% Europe, 10% China, and Japan. And you can see as well the evolution over time, where US have been stable, same for Europe. Japan is a bit less than before, and China, on the contrary, gained by 10% over the last 15 years. So China has been big in the bond market. So let's look now, as we have done before for Microsoft for stocks, let's look at General Electric bond. If you go into the FINRA website, again, you'll be able to find these bonds. So as you see here, you get the name here of the bond, the coupon, what's the maturity, 2027, the QSIP, which is the single and only number attached to the bond, and different specification. Let's look now at the foreign exchange market. The foreign exchange market or FX market is open from 22 GMT on Sundays until 22 GMTs on Fridays. As you know already, and this is no surprise, a foreign exchange transaction implies the purchase of one currency and the sale of another currency. The two currencies involved in the transaction are called a pair. We know as well from the Bank of International Settlements that recorded the trade in 2016 that the average volume was in April 2016 of 5.1 trillion per day. So you can see that the FX market is the largest financial market by far. And in this market, the US dollar was on one side of 44% of all trades. The sales desks are in 5 countries, roughly, the UK, the US, Singapore, Hong Kong, and Japan. And they do deal with 77% of FX market, meaning that if you look at the different time zone, that the FX market is 24 hours of the day active. And here, the second reason of why this market is so big is the market participants go from banks, central banks, asset manager to companies and retail investors. So every market participants are active in the FX market. Foreign exchange, when we do an FX trade, we are buying one currency and we are selling another currency. Here, I took the example with the euro dollar. So let's look at the euro dollar quoting bid ask 111.83, 111.88. What is important to remember is the euro is the base currency. This is the currency on the left. Whilst the USD, the currency on the right, is the quote currency. So the ask represents the price at which we can buy the base currency, here the euro. So we can buy 1,000 euro for 1,118.8 US dollar. As we are buying one currency and selling another one, when we will do investing or trading, we will have to analyze each currency and each economy on absolute terms and on relative terms, as we are buying one and selling another one. So as we discussed before, the US dollar represents 44% of all the FX trades. Here you can see in the second column it's 88%, but you should take into account that as there is a buying currency and a selling currencies, the total is 200%. So take half of the 88%. Then you do have like Europe, which represents roughly 15% of all the FX trades, 10% for the Japanese yen, then 5% for the sterling. Currencies are divided into three segments. The first segment is called the major currencies. The major represent the most traded currency pairs. They are very liquid. Here, there are 8 major currencies: the US dollar, the euro, the Japanese yen, the British pound, the Canadian dollar, Australian dollar, the New Zealand dollar, and the Swiss franc. And all of them are have in the market different name: euro dollar, dollar yen, pound dollar, or cable, dollar Swissy, dollar loonie, Aussie dollar, and Kiwi dollar. The second segment of the currencies are called the minor currencies. The minors, or cross-currency pairs, do not contain the US dollar. So in that pair, you will not see the US dollar. They are less liquid, depending on natural supply and demand from economic relations. So here are the examples below of some minor currencies, where you have the euro sterling, the euro CAD, or the sterling versus the Swissy. And finally, we have the exotic currencies. Here, all the currency pairs are the ones that have not been mentioned above. That includes one major currency with one exotic currency. Here, be extremely careful, as the liquidity can vary greatly between pairs. So you can have decent volume or liquidity or very poor liquidity. That might be paired with the currency of an emerging economy, meaning that the volatility will be higher than a developed pair. Here's some example with the USD ZAR, the US dollar versus the Swedish krona. Let's jump now into the commodities market. In the commodities market, you have what you call the hard commodities and the soft commodities. The hard commodities stands for metal and other solid raw materials, and that is a commodity that is mined or obtained from some other non-agricultural source. So examples here will be oil, gold, silver, or copper. Versus the soft commodities, which are commodities that are grown. Here we are talking about sugar, for instance, coffee or soybean. A second way of looking at commodities is by looking at agricultural commodities, energy commodities, metals, and gold on its own. In fact, gold could be seen as a commodity and as a class asset on its own. The commodities will be affected by supply and demand, substitution, weather, US dollar, risk on, risk off, and many other different factors. So what is the size of the commodity market and how do we trade commodities? The first thing, we can be buying the physical asset. The second one, we can use an ETF. So example will be the GLD for gold, USO for oil, SLV for silver, or corn for gold. Many market participants or professionals do use futures contracts, which is a physical delivery of the commodity, but it rarely occurs as the delivery contracts are usually exchanged or closed out, traded out before the expiration date. An example here is the crude oil future from CME. And what you can use as well as retail trader is the contract for difference, or CFDs. Those commodities trade on commodities market, the CME, the NYMEX, which is part of the CME, or the ICE, or the LME. So here I try to list the 10 top commodities, which goes from the crude oil to copper. And as you can see, there are the links for the different websites, and mainly it's about the CME group. So let's now look at the money markets. So money markets are short-term maturities. They go from overnight to 1 year. Money market instruments are used for borrowing and lending short-term. Here, the different actors are corporate, banks, financial institutions, and government agencies. So that means that for us, retail traders, this market is going to be hard to get access to. It is a very liquid market, and money market instruments trade over-the-counter markets, so OTC, and are not regulated. There are 5 major markets: the certificate of deposit, CDs, the commercial paper, CP, swaps, repo, and government treasury securities. Something that is to remember here is the money market is very, very important for central bankers to control liquidity and interest rate level. So let's try to sum up what we've went through during this video. First thing first is each asset class offers different number of tradable underlying products on regulated markets or OTC. So that means if we are on regulated markets or OTC, the risks are not the same. Secondly, they do own different market participants, which could affect market sophistication. Obviously, the more players you have in one market, the more sophisticated the market will be. Then, for asset allocation, what is important is the correlation to economic cycle and market conditions. And here, this is the most important aspect of this video. Depending on where we are in the economic cycle, we will differently allocate capital between asset classes, sectors, and regions. Then, as we've seen before, asset classes carry liquidity and trading hours. They have different capital requirements, meaning overall, looking at all those metrics, they have different risk reward. So that means all those factors combined will greatly dictate how we will do our asset allocation. And this is something that we will do more in depth in the next videos. Thank you.